Another huge bankruptcy just rocked Wall Street. Could this be the spark that ignites a full-blown credit crisis like back in 2008? If you're worried about your investment, stay tuned for 3 steps to understanding this financial shock and how it might affect you. Welcome back to StockScope Live. I'm your host, Ali, and today there's breaking news coming out of the massive shock that hit Wall Street with a new bankruptcy in the last 2 weeks, raising fears of a new wave of financial contagion. Are we about to see history repeat itself, or is this just a bump in the road? In this video, I'm going to walk you through 3 essential steps to understand why this matters and how shadow banking fits in and what might be coming next. Before we start, you might be thinking you've already heard about First Brand's bankruptcy. But what's new here is information that came out of bankruptcy court filings. First, let's take a step back and understand the first point, which is the shadow banking system and private credit. We need to understand the shadow banking system and how it works. This is a network of non-bank institutions involved in lending and investments. They're operating with less regulations and transparency than traditional banks. Companies like Jefferies act as a financial intermediary, managing assets, providing loans, and taking on risk, sometimes without safety nets or scrutiny you would expect. Now, recently, Jefferies made a critical mistake by lending to an auto parts manufacturer called First Brands. And that company, First Brands, just filed for bankruptcy. This exposes how fragile private credit can be. Unlike traditional banks, shadow lenders extend credit under the table, making it extremely difficult to gauge true risk. Now, you're seeing headlines increasingly mention private credit, but what's really going on is a web of opaque deals with poorly understood counterparty risk. Let's take a look at this article that was reported by Reuters talking about what happened in court filings. The trade finance company Rainstone, which is a creditor of First Brands, asked the court on Wednesday last week, on October 8th, to appoint an independent examiner, claiming that as much as $2.3 billion simply vanished from the bankrupt U.S. auto parts supplier. First Brands filed for bankruptcy protection last month after its lenders began investigating irregularities in the company's financial reporting. The company has had $11.6 billion in total liabilities, according to the court documents. Now, this money that they're missing isn't money they borrowed and spent and can't get back. It's money they actually just lost. Imagine taking money, putting it somewhere in your house, and then forgetting where it was. You didn't spend it, you simply lost it. Now, First Brand had earlier appointed a special committee of independent directors to probe its off-balance sheet financing and whether invoices were factored more than once, because it believed it had an unpaid $2.3 billion hole on its balance sheet related to third-party factoring arrangements when it filed for Chapter 11 proceedings. Factoring in a financing method used by companies to sell outstanding customer invoices to investors in return for cash. So basically, when you go to a financial institution, you say, hey, I have $100 million in receivables, and I'm going to use that as collateral to get a $10 billion loan. But what First Brands did was they didn't just go to one lender, they went to multiple lenders and asked for a different loan using the same receivables. And none of those lenders knew that other lenders were using that receivable as collateral. So every lender thought that they were safe. And then when the house of cards fell, all the lenders found out that none of them were safe except maybe one. Now, according to this, First Brands collected roughly $1.9 billion of factored receivables without remitting to the proper owners, according to the filing. After the Ohio-based company filed for bankruptcy, its attorney told Rainstone in an October 2nd email that they did not know if the company even received the $1.9 billion. And this is the big question. And it's actually hilarious. Following this, Rainstone requested an independent investigator. So here's what happened in court. He asked them. They asked the auditor lawyers. They said, first, do we know whether First Brand Group actually received $1.9 billion, regardless of what happened to it? And then he said, second, would you tell us how much is in the segregated accounts in respect to the factored receivables as of today? Meaning how much money do you have we can use for payback? In response, the First Brand lawyer said, number one, we don't know. They can't even confirm if they received the money. And number two, nothing. Yada. $0. If this sounding crazy, it is. Now, Wall Street insiders and hedge fund managers are worried. They're saying, where there's smoke, there's fire. Not only did First Brand lose $2 billion, some say that money may have never existed. Allegations of financial misconduct and fraud are surfacing, especially around the collateral being pledged to multiple lenders. Now, this is called rehypothecation. And this means that creditors, many of them believe they are protected. But when the bankruptcy hits, the collateral's vanished. These patterns match what we saw before the 2008 crisis. As bubbles grow, so does fraud until it becomes systemic. There is a legendary investor, Jim Chanos, and others are openly comparing today's shadow banking risk to the subprime disaster of 2008, citing too many layers between the money source and the borrowers. Key point number 3 is the implications for the market. Could this trigger the next global financial crisis? Well, it depends. Because when liquidity freezes and assets crash from $100 million overnight to $100, counterparty risk packs a punch. The shadow banking system links risky corporations to intermediaries and traditional banks. If one of them fails, the dominoes follow. Remember, when the tide goes out, you see who's swimming naked. If economic shocks pile up and more bankruptcies follow, we could see credit freeze and a rapid cascade. If the economy and labor market hold steady, we may weather the storm. But continued deterioration could accelerate risk exposure, forcing the government intervention. So do I think this is the beginning of the GFC 2.0? Well, the next few months are crucial for us to find out, especially for investors, policymakers, and financial professionals. Because I think that as the tide goes out and the first and second lines are exposed, the government, meaning the Fed, is going to step in and kick the can down the road temporarily. So make sure you stay vigilant and make sure you subscribe to the channel for up-to-date information. Stay safe, stay diversified, and I'll catch you in the next video.